Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments.
All right, let's get into it. What we're narrating today is the U.S. market peripheral notes from Monday, March 16th, 2026.
And just a reminder, this video presents a direct informational narration of that source document.
So here's our plan. We'll start with the important risk disclosure, then dive into a market overview. After that, we'll examine the situation in the Strait of Hormuz, look at a macro environment stress test, unpack the pressures on the semiconductor sector, and finally, touch on some key corporate movers and geopolitics. Okay, first things first, we have to cover the risk disclosure and important notice from the source.
This document is for informational and research purposes only. It is not investment advice, a recommendation, or an offer to buy or sell. Investing involves significant risk, and that includes the potential loss of your principal. The prices of all financial instruments can and do fluctuate materially and unpredictably. Any views in here are for reference only and are absolutely no guarantee of future performance.
Investment decisions should always be made independently by you, the reader. Market conditions can materially affect performance at any time. And please remember, past performance is never an indicator of future results. And finally, the information here is time-sensitive, and it's subject to change without notice.
All right, with the disclosures out of the way, let's get to the heart of it, the market overview. The report frames this moment as a mix of a geopolitical contest, a compute bubble, and a liquidity inflection point. So what actually happened on March 16th? Well, after some pretty wild swings, the U.S. market staged this big relief rally, mostly driven by oil prices pulling back and the kickoff of NVIDIA's big conference.
But, and this is a big but, the document warns us not to take this rally at face value. You see, the worst performing assets of the day were actually the funds that bet against the market. So what does that really tell us? It suggests this wasn't some newfound confidence. It was much more of a technical bounce. Traders who were short the market got squeezed and had to buy back their positions. It's a short-covering move, not a genuine trend reversal.
This all comes down to a really important chain of events. That pullback in oil prices, that was the direct trigger for the market bounce. And here's the key domino effect to watch. The report estimates that if oil stays above $90 a barrel, it could actually cause about a 1% contraction in U.S. household spending. So even though the market looked a little better on the surface, there's still this huge geopolitical risk premium and a ton of economic pressure bubbling just underneath. And that leads us directly to the epicenter of all this oil volatility, the Strait of Hormuz. I mean, this critical energy artery has been on a total knife's edge. Tensions just exploded in the last 48 hours after a U.S. strike on Iran's Karg Island oil hub. The market immediately went into panic mode, thinking oil supplies would be completely shut off, and that sent prices surging over 3% right at the open.
So, in an effort to cool things down, Treasury Secretary Bessent came out and announced that Iranian oil tankers would be allowed to pass through the strait. The report dubs this the Bessent effect. It definitely calms some nerves, but it's not clear how effective it's going to be in the long run. At the same time, you've got former President Trump calling for a justice alliance. What's interesting is that the big institutional investors, the so-called smart money, they seem to be totally brushing this off as just political noise.
Now, let's look at the hard data, because this tells the real story. As you can see here, before all this conflict, you had about 77 vessels passing through the strait every single day. Normal. Then, on March 14th, that number dropped to 0, a complete and total halt. By March 16th, we saw one ship, the Karachi, make a symbolic exit. But the report calls this a one-way exit, basically a sentiment-driven photo-op. The real sign that things are getting back to normal, we need to see 20 to 30 vessels moving through daily. We are nowhere close to that.
So the report's conclusion is that this little recovery is basically an illusion, that one ship was just an isolated case, letting a stranded vessel leave, not letting new traffic in. And this really highlights the massive gap between what the market wants to believe and the reality on the ground, which is why this warning from JP Morgan is so critical. If oil holds above $90, the S&P 500 could face downside correction pressure of 10 to 15%.
Now, all of this is feeding into the bigger macro environment. We are heading into what the report calls a super central bank week, and these high energy prices are really forcing their hand. The markets are now pricing in much more hawkish policies, betting against rate cuts from both the Fed and the Bank of England. And what does that mean? It means the easy money that has been propping up the market is starting to dry up, and the whole system is facing a major liquidity stress test.
This brings us to a potential liquidity trap. Yes, the S&P 500 did bounce off its 200-day moving average, a really key long-term support level. But the report is crystal clear. Unless the index can reclaim the 6,800 level and actually hold it, the downtrend is still very much in play.
And on top of that, you've got this immense automated selling pressure. According to a Goldman Sachs model, the big trend-following funds, the CTAs, they already yanked $50 billion out of the market last week. And it's not done. That same model is predicting another $70 billion in mechanical selling over the coming week.
And here is the real volatility kicker. This Friday is triple witching. That's when a massive volume of stock options and futures all expire at the same time. We're talking about $1.3 trillion in notional value. With retail buying already starting to fade, an event like this could create a liquidity vacuum, a sudden shortage of buyers, which could send the market spiraling down pretty dramatically.
Okay, let's zoom in on a key sector that's really feeling the pressure: semiconductors. Man, it is getting squeezed from every direction. On one side, you have costs going up, with big manufacturers like UMC and PowerChip planning price hikes of around 10%. On the other side, you have supply bottlenecks for things like Intel CPUs already hitting cloud providers and hardware makers. And all of this is happening right as NVIDIA is facing a potential sell the news trap.
The document's take on NVIDIA's GTC conference is, well, it's pretty pointed. It interprets Jensen Huang's $1 trillion vision as a kind of smokescreen for big players to distribute shares at these high prices. What happened was, high-frequency trading algorithms jumped on the headlines, pushing the stock to $188, and that provided the perfect liquidity for smart money to sell their shares to retail investors chasing the momentum. The technical signal now suggests the stock price is likely going to keep falling, searching for support around the $177 area, or maybe even lower.
And finally, let's touch on some specific companies and geopolitical risks that are really making waves in this environment.
First, we've got Nebius. Their huge $27 billion deal with Meta is a clear signal that the tech giants are in an all-out arms race to lock down computing capacity. Then you have Oracle. They raised their 2027 guidance, but the report sees this as a way to mask the intense pressure on their profit margins. Plus, they're incredibly reliant on just two huge clients, OpenAI and xAI. On the geopolitical side, there are reports that Iran's new supreme leader traveled to Russia for surgery. This could create a dangerous power vacuum in Tehran, a real black swan event. And lastly, a specific high-risk warning on the company BATL. Its stock volatility has totally detached from its fundamentals, which looks like a classic liquidity trap to avoid.
So what's the bottom line from all this? The market is really in a danger zone, caught between this wave of automated selling and major geopolitical risk. Monday's rally felt weak, and it looked a lot like big players were just selling into the bounce. This brings us back to the single most important metric to watch, the number of vessels passing through the Strait of Hormuz. As long as that number stays below 20 per day, the report advises treating any market rebound as an opportunity to reduce exposure, not as a reason to buy.
And to conclude, let's just review the final professional risk disclosure from the source document. This document is not investment, financial, or trading advice. The author is not a registered investment advisor. Investing involves substantial risk. All views are for informational purposes only. Readers are responsible for their own independent research and decisions.